Good morning, everyone, and thanks for joining us today. I hope you are all keeping well. My name is Jill Halford, and I'm the National Head of Charities at BDO. Just to make sure you're all in the right place, you've joined our annual charity technical update, and you're all very welcome. We've developed this series of webinars to assist our charity clients. We've had a number over the last 18 months. And if you couldn't attend the previous ones and are keen to watch the recordings, then please do let us know. We can send you a link, and you can also register for them on the charity pages of our website as well. So just before we get started, a few housekeeping points. Today's session is going to be recorded. That allows us to circulate the slides and the recording early next week, hopefully, when those are ready, for those that have obviously attended, and also those that have registered but unable to join us this morning. We are due to have about 200 people on the call. So please, if you can, make sure when the speakers are talking that you are on mute. That would just really help the sound quality. And I'm sure you will have a lot of questions as the speakers are going through their sessions. If you hover your mouse towards the bottom of your screen, you should see a range of options come up. Q&A and the chat function. If you could pose your questions through the Q&A function for us as the speakers are talking, that would be incredibly helpful, and we're hoping to spare some time towards the end just for a Q&A session. If you're having any technical issues, we're ably supported by Hannah in the background, so again, please use the chat or the Q&A function to just let us know about those, and we'll try and resolve those as soon as possible. So what are we going to cover today? So we'll kick off today's session with an audit and accounting update. That's going to be led by Liz Carr. Liz is the head of our not-for-profit technical standards group, so you're in very good hands there. Then we'll be followed by Parul. Parul's a VAT director specialising in not-for-profit, and she's got a fabulous way of explaining the complex area of charity VAT to make sure that even I can understand it. So I'm looking forward to that session. Following that, we'll have Caroline Harwood, one of our partners in the tax, our tax team, who's going to talk us through employment tax. And she'll be joined by Matt Harrison, just to give us an update around where HMRC are with furlough. So an interesting topic. Really pleased to then be joined by Joe Goswell. Joe's going to talk us through the global context, and very interesting for charities that are working overseas or thinking about expanding overseas as well. And then we're going to test our technology, because we're going to be joined by Jason Gottschalk, who many of you will know from our last webinar, heads up our cyber team. And Jason's going to try and join us from South Africa. So we're hoping that technology is our friend, and that he will be able to walk us through his session. So without further ado, I'm going to hand over to Liz.
Oh, thank you, Jill. Good morning, everybody. As Jill introduced me, I'm Liz Carr. I am the director that heads up our technical standards group that supports our audit teams, that support you as our charity clients and other not-for-profit entities. Today, I've been asked to go through some particular accounting and audit updates. The agenda here of things I'm going to talk through are, first of all, around some of the updates around financial reporting, SORP and narrative reporting, and then specifically to pick up on a topic where we've been asked lots of questions by our clients recently, and it's our approach to the audit of defined benefit pension schemes. Okay, so if we move on to the first slide, the financial reporting and accounting updates. You'll be pleased to hear this year we don't really have very much to tell you. In terms of updates to UK GAAP and FRS 102, there are just a couple that I want to draw to your attention. The first one on the screen here is around the amendments to FRS 102 around interest rate benchmark reform. And this is to do with the move from LIBOR to SONIA, and particularly affects entities that do hedge accounting. Now, we don't see a great deal of that across our charity clients. We do in our social housing clients, so I'm not going to dwell on that too much this morning. The second one where I'm going to spend a little bit of time is around the extension of the amendments to FRS 102 around COVID-19 related rent concessions. So this is specific to both lessees and lessors with operating leases. So if we look at the detail of this one, I think I talked through this one last year. It has been extended for a further 12 months. So the specific amendment applies to periods beginning the 1st of January 2021 onwards. So that would be 31st of December 21 year ends onwards. And it applies to any temporary rent concessions that have been offered or received as a direct consequence of the COVID-19 pandemic. Now, you must apply this treatment if and only if the following conditions are met. So that's where we have a change in lease payments that have resulted in revised consideration for the lease that's less than consideration for the lease immediately preceding the change, which is quite a mouthful. But what that means is that you have had rent waived or reduced as a result of the pandemic. So this relates to any reduction in lease payments that were originally due on or before the 30th of June 2022. Now, the change in this amendment was that this has been extended by a year. So previously this was up to the 30th of June 2021. And the final condition is that there are no significant changes to any other terms of the lease. So as an example, if you were to have offered a rent holiday in the period of, say, March 2021 to June 21, where in that period the rent's been waived, then the lessee would recognise no lease expense in that period. Okay, so if we move on to the next slide. In terms of charity SORP updates, I have nothing to tell you. There are no changes to the charity SORP this year. And actually, no new information sheets have been issued either. Over the last few years, we have seen these information sheets being released on various different topics. Now, these information sheets, they're intended to advise preparers of accounts on particular implementation issues. They are the kind of the authoritative view of the SORP committee and its advisors. So they don't form part of the SORP, but they do offer additional information for anyone preparing financial statements. So I've just put the summary there of the ones that are currently available. A couple of them I will refer to later. That's information sheet 3 and number 5. Okay, the next thing I just wanted to run through with you today on the next slide is we quite often get asked for example financial statements, particularly over the last couple of years with the significant impact of the pandemic and various issues that I know we're facing across the sector. There has been on the Charity SORP website, there have been a couple of additional example financial statements released, which are kind of COVID versions. So they have updated the existing, if anyone's looked at these before, they've updated the existing examples they have on there, ones around the Arts Theatre Trust and the Rosanna Grants Trust. So if you do want to look at an example, then they are available and we have provided the link there of where you can find them. So that's it from a kind of financial reporting accounting update. As I said, not too much to tell you this year, which I hope is a welcome relief for you all. Where I want to spend a little bit of time now, though, is around narrative reporting. There's a real direction of travel at the moment is around a real focus on quality narrative reporting in our financial statements. Again, we've had lots of questions recently from our clients, particularly where our audit teams have provided challenge on some of that narrative reporting. And I just want to draw your attention to some publications that have come from the FRC. The first one is they've released at the back end of 21, they've released a thematic review around viability and going concern disclosures in financial statements. Now, this is a corporate example. These are all based on large companies, so they don't unfortunately include any charities within this, but it's all really useful information. So if you are being challenged on those going concern disclosures, or you're responsible for putting those in the financial statements, it is a really useful document to take a look at, just to run through some of the points that they make in terms of best practice. So if we move on to the next slide here, what they've asked particular questions in this thematic review. So they've asked, how have companies navigated through the pressures and uncertainties of COVID-19, and how do companies intend to maintain their solvency and liquidity? Now, the viability part isn't really particularly relevant to our clients, but the going concern information in this is really useful. And their general feedback was that across the board that some improvement is needed on those disclosures. They stress that the going concern disclosures need to be informative, they need to be specific, they need to be clear, but they also need to be concise. We don't need huge lengthy tomes of information. What's included does need to be quite direct and to the point. They talk through using opportunities for cross-referencing, so you don't have clutter in your financial statements. But what they do really stress through this is where there is uncertainty, where there are significant assumptions, where potentially you have a material uncertainty related to going concern, then they want more granular detail about the qualitative and quantitative information. And what they do here is, as they run through that, they actually give you snippets of real life examples that are in published financial statements. So they don't just give a statement without any context. So you can actually go in and have a look when they're making their points on a very specific example from lots of kind of listed companies within the UK. They really make it clear on making sure that the information in that going concern disclosure is consistent with other information in the financial statements, particularly if you've got significant judgments related to going concern. Do those tally with the significant judgments that you've disclosed in your accounting policies section of your financial statements? They do go through some really good examples in the things around how you define the period of assessment of your going concern. When you're looking at your going concern assessment, the requirement is that you look at least 12 months into the future from the date that you're going to sign your financial statements, and they offer best practice on how you actually define that period. They go into a bit more detail in certain situations when you may be close to breaching a bank covenant, or if you need to refinance. So as I say, it's quite a useful document if you are the individual who's pulling together some of these going concern disclosures, and you can just, if you're interested in having a look at best practice. The next one I just wanted to highlight is around is the FRC Lab report, and they call it the Reporting on Stakeholders Decisions and Section 172. So the Section 172 statement is something that's been required for large companies, including charitable companies. And the requirement came in for reporting periods beginning on or after the 1st of January 2019. So it is something quite new. As I mentioned before, the information sheet 3 does specifically go into the requirements. It's large charitable companies would be captured by this, and that information sheet is really useful in defining what constitutes that large company. And it also puts it in puts some of this in kind of a more charitable context. Now, this specific review, again, it looks at actual disclosures in company financial statements. They've split the report into 2 sections. So first of all, they look at some information on stakeholders. And the second part they look at within the requirement is the information on decisions made in the period. And what they do then is they bring that all in together in providing some best practice on how that gets incorporated into the Section 172 statement itself. So if we move on to the next slide, some of the information that they then include on the information on stakeholders. So if we can move to the next slide, please. The information on stakeholders is, they run through various different points, like how do you identify those relevant stakeholders? The disclosures about what's important to them. How the entity builds and maintains those strong relationships with the stakeholders. Are there any risks to those relationships? And how is that relationship monitored between the entity and the stakeholder? The second section, they talk through the information disclosed on the decisions. So it talks around how they've identified some of those significant decisions made during the period. You don't need to disclose all decisions made, but we need enough information on what's really important to the charity or the company in that period. How that links to the company's purpose and the strategic priorities from a charitable context, how that links to the charity's objectives. It gives examples around how decisions were reached, any difficulties and challenges that the entity faced, and then it wants some information around the expected or actual outcome of those decisions. So if we move on to the next slide, they do then talk through some helpful tips then in bringing that all together and preparing the Section 172 statement. It says one of the big areas of feedback is that lots of entities, and we see this in our own charity clients ourselves, is we put lots of emphasis on the identification of stakeholders part, and we don't necessarily have as much information there on the principal decisions made during the period. And I think that that's a really key thing that they've pulled out across the board, and they want more focus on that second part of the statement. You know, they want it to be something that that's a really useful document, and I think there's a bit of kind of boilerplate information in there, so they want it to be made very relevant to the individual circumstances of the entity. So if you do want to go away, provide you the link to this one, it does give you those examples, and it does hopefully put into context some of that challenge that our audit teams may provide when we're doing that review of the financial statements as part of our audit. And then moving on to the next one that I wanted to draw to your attention, this is around another thematic review, and this one is on streamlined energy and carbon reporting. Again, this is a requirement for large companies. This one came in for periods starting on or after the 1st of April 2019. So I think March 21 year end, March 20 year ends were the first time we saw this in our financial statements. Now, this specific thematic looked at 27 different entities across a whole range of different industries. Unfortunately, again, there isn't a charity in there, but they had a really good look at those disclosures. And again, they've provided some feedback. The key observations that they have in this thematic is that actually most entities have complied with those minimum statutory requirements. So there is some really good information out there at the moment. But the things that they want to draw to attention in this one is around more work needs to be done to make some of those disclosures a bit more understandable and relevant to the users of the financial statements. And then finally, they have a section in this one where they talk through some of the emerging best practice. So if we move on to the next slide here, there are 5 key areas of findings that they run through. First one around the actual disclosure of the quantity of emissions and energy consumed. They make particular recommendations around just being really clear which entities, if you're in a group, are included in that disclosure, because they're not all captured. They have some recommendations around the disclosure of the methodology used to calculate the emissions and the energy consumption. They want a bit of information about how you've developed that methodology, and actually if you've gained any assurance over that from an external party, state it in the disclosure. The third one is around, there is a requirement to state a ratio of emissions in relation to a quantifiable factor. Now, there is choice for each entity on how you, and what that quantifiable factor is and how you've determined that. So their recommendation is around explaining that choice of ratio. And if the quantifiable factor, if that number or data doesn't come directly from another part of the financial statements, then to include a reconciliation of where that number comes from. Moving on, the next one is around the requirement to disclose some energy efficiency measures. They just want clear disclosure of any principal measures. We don't need huge reams of information about everything that's been done within the organisation. And then finally, this is more in the context of some of the larger companies who have additional now reporting requirements, but they do have recommendations about using cross-referencing. It's about cutting the clutter from the front end of our financial statements. This should be concise and relevant information. So if you can cross-reference to other parts, then that is permissible here. So yes, that was everything I really wanted to talk through on this one. Final bit on the next slide was just they do highlight some areas and examples of good practice. They do highlight, they like that some entities have gone beyond what's required, and they've included some voluntary disclosures. And then the other thing they also draw attention to that they quite like is around the disclosure of any emission reduction targets. So again, if you do want to have a look at some, after producing these yourselves, if you do want to look at some real life examples, and they are snippets within this thematic from actual company financial statements, then it's a really good document, which should hopefully put it in context for you. So that was it on that section on narrative reporting. The final thing I want to talk to you today is something, it's an area that we've been getting lots of questions from our clients on recently. It's around the audit of defined benefit pension scheme balances within your charity financial statements. We have updated our internal policy and guidance on this. This is as a result, I mean, you all know auditing is constantly evolving. We've had feedback from our regulator. There's been lots of guidance issued on this topic by the ICAW, and I will draw attention to that in a moment. And we have emerging best practice. So you may feel this year, or maybe last year as well, that we're doing a little bit more work than we have in the past around auditing those balances. So this is a situation where, when this is not the audit of a pension scheme itself, this is a situation where you have a defined benefits pension scheme and you generally have that net liability included on your balance sheet. Now, as an auditor, we need to really acknowledge that that net position is actually made of two components, that there's an asset component and also a liability component. And to the extent that those individual balances are material to the financial statements, we need to audit them separately. So we need to think about, as part of our audit planning, we need to identify and we need to assess those risks of material misstatement associated with both the asset component and the liability component. Now, just to make it clear, this could be where you are the only member of a scheme, or you're a member of a multi-employer scheme, like a local government pension scheme. It's relevant for both of those situations. So if we move on to the next slide. So as I say, we need to really understand, as part of our risk assessment, the nature of that scheme, and we need to think about the risks in order to form our audit approach. Now, we need to make inquiries and we need to obtain any necessary evidence so we can understand, confirm, and document the following bits of information. So first of all, we need to think about the arrangements for the management, the custody, the valuation, and the reporting of scheme assets. So in lots of these situations, there are other entities involved. There might be service organisation, there might be various different experts. So we need to understand the nature of those individual entities involved. We need to understand how they're involved and in what capacity. And when we think about the scheme liabilities, we need to also gain that understanding, document and confirm that the arrangements for the valuation of the scheme liabilities and the reporting of those scheme liabilities. So we need to be clear about who's responsible for those actuarial calculations. Going back to the scheme assets, we need to understand actually what is the composition of those scheme assets. What are the different types of investments that are within that portfolio of assets that are attributed to the employer? We need to understand any procedures and processes and any controls which you have yourself within your organisations to ensure that, you know, the defined benefit assets exist and the liabilities exist, that they're valued appropriately and that they're accurately recorded. So as you can see, even at our risk assessment stage, there's a lot of work to do. Now, this can pose various challenges. So if we move on to the next slide here, as I've said before, there are various different parties involved in this process. So as you know, we will be auditing you as the charity entity. We're not the auditor for the pension scheme. So we try and have to get hold of all this relevant information. So there'll be a pension scheme itself. There'll be the pension scheme trustees. There'll be potentially separate administrators, so that's where the trustees have delegated the certain parts of the administration to a separate party. There'll be investment managers, so that will be where they have another party that will be managing those funds available for investment. There might be a separate or multiple custodians who might hold those investments on behalf of the scheme. The scheme itself will produce its own financial statements. They'll have their own auditors and actuaries. And then for you, our clients, you will have your own actuary involved. So, and then thinking about ourselves, we appreciate we're auditors. We're not necessarily pension experts. So we will engage usually with our own actuaries and maybe our own in-house valuers in terms of looking at some of these assets. So as we can see, there's a whole host of different parties, and this can be quite challenging in trying to make sure that we get the relevant information from each of those parties. Now, again, if we move on to the next slide, the best audit information that we can get is when we receive information direct from a third party, where it comes directly through you, not through you as our clients. And the issue we have with auditing these balances is that again, as I said, we're not the auditor of the pension scheme. So we don't necessarily have the relevant permissions or the authority to get access to the information that we need to complete our audit work. So what we will do is we will direct these requests through your management. We will ask you in turn to communicate with the trustees of the pension scheme in order to seek the authority to give us and to give the necessary permissions for us to get access to the relevant data. Now, I'll just run through quickly some of the actual procedures that we'll be undertaking. So when we're looking at testing the valuation and the existence of those investments and the other assets, this is quite a similar approach you might see to our work when we're looking at any investment portfolios that you might hold yourselves. So we can take various approaches. We can take a controls approach. We can take a direct substantive approach, or we can take a combination of the two. Our preference is usually, and something's much more straightforward for us, is if we can take a controls approach. And what we try to do is to obtain some internal controls reports of some of the various parties involved, and we seek to rely on those reports as part of our audit work. So this might be a report on the controls within the investment manager, for example. So this is by these controls reports, we mean that this is where the party has gone out and got independent assurance from a third party or an auditor around some of those controls that they have in place. And what we will look at is those reports. We will look at the various findings, and if they've got that positive assurance, then we'll seek to rely on that report rather than doing any specific detailed work on that area ourselves. Another step that we'll take is that we'll try to get a direct confirmation from the custodian that the investments held are actually in the name of the scheme. We need that kind of information. We'll get hold of the investment valuation report from the investment valuer, so we can agree the value of those scheme investments. And then finally, the thing to draw to your attention here is I talked about the composition of those assets. It gets a little bit more complicated for us where we have complex investments. So this might be where there are things like hedge funds or pooled investment vehicles, and things we really need to get a bit more understanding and get under the skin of the nature of those investments. And we might seek to get additional information, such as the audited financial statements of the funds themselves. So I know I've gone through that very quickly, but I just want to demonstrate to you there is quite a lot of work that we're required to do where you have that defined benefit liability on your balance sheet. I have included a link here to some ICAW guidance, which is really useful. It goes through that in a bit more detail and a bit slower pace than I have. So if anyone wants to have a look at that and digest the information, particularly if you're interested in how we seek those approvals to get hold of the necessary information, then I would like to direct you to that. But that's everything from me this morning. Thank you very much for your time, and I'm going to pass over now for the VAT update.
Thank you, Liz. I have to say, coming back to sort of Jill's introduction, I'm Carolyn and I'm a VAT specialist here at BDO. When it comes to VAT, I'm aware that things can get complicated and technical very quickly. And so for the purpose of providing you with an update, I'm going to take you through a selection of areas where HMRC are currently taking an interest, Hopefully this will help you identify what it means to you and what you might want to do next. Most of the issues are focused around the impact of change, which has been driven by external events. Now, I think the two most critical events are COVID and Brexit. And then the latter half of changes come from changes in HMR's approach to specific issues. Now, those could be triggered because of case law changes or changes to legislation. Stepping back, I think when you are considering VAT, it's important to remember that the VAT outcomes is likely to impact either the net amount of cash available to the charity in a positive or negative way, depending on how the issue is dealt with internally. I am going to be focusing on a selection of issues given the time scale, but for those of you that are interested, we do have a tax seminar next week where we'll go through these details in greater scope and a range of additional issues. Next slide, please. So in terms of key issues, I think I'll focus on firstly compensation and termination payments. Now, here's an example of an area where HMRC has recently changed its position. It did so a few weeks ago and announced it in a business brief. It provides an important update on what HMRC believe the VAT treatment should be in certain situations. And it replaces their previous statement of understanding as of September 2020. And it steps away from the traditional approach that you might be aware of, treating compensation and termination payments as outside the scope of VAT. This issue is likely to apply to all businesses and charities, irrespective of whether your contracts contain termination clauses or not. And it's going to cover the broad range of issues ranging from, how you contract for office supplies to the big things on leases, for example, on buildings. So where are we now? HMRC believe that most compensation and termination payments will follow the liability of the underlying supply. And that's where the payment that you make is set in line with the payments that would otherwise have been due under the contract. It's important to note that exceptions do remain. And so if you have punitive payments which are designed to punish a breach, or if there are liquidated damages because your suppliers failed to do something, or the common example of dilapidation payments where you or your tenant may have failed to return the property in an agreed state of repair, payments due. Now, in those three circumstances, broadly, we'd expect those payments to remain outside the scope of VAT. But that's subject to a review of the specific circumstances, the terms and conditions. The revised positions effective from the 1st of April, and I think what's really important to note is that this treatment replaces any previous rulings that you may have had from HMRC on these types of transactions. Ultimately, stepping back, we think that VAT is going to be payable on more types of these transactions, so exit transactions, and therefore for charities it's likely to increase cost. For a short window, I think there's an opportunity for HMRs, for taxpayers to go back and have a look at the exit charges that you might have paid in the last few years, because if that was payable under the interim HMRC policy, they are allowing you to go back and reclaim the overpaid VAT. So it's worth a review there, both as a customer where you may have paid those charges, but also be aware that any customers that you've had where you've raised charges, they may be coming back to you for a review of that treatment as well. I think this is something that's typically will not sit in finance teams, but will involve some sort of involvement from procurement and contract teams. If I move now to external events, I think it's clear that during COVID, charities will have changed the way they've used assets, and I would say particularly buildings. For VAT purposes, this requires you to consider whether a VAT adjustment is due. Typically, VAT is recovered on business use that is taxable, and these are the areas where we've seen income drop, either because tenants have exited or retail activities, for example, have reduced significantly. Now, for temporary changes of use, HMRC have accepted that they'll allow an easement and allow you to balance out the change in activity through an agreement. So they're accepting requests for written changes to partial exemption methods, and I think that's still open. And typically this is something that you should do by the end of this financial year. I also believe that customs are being flexible and are allowing limited backdating. If the change in the use of your assets has been permanent, then it's likely that there's going to be a payback requirement. So here you'd go back to the capital goods scheme and make adjustments through your VAT reporting. Just very briefly, in terms of an example of where case law is really kicking in and we're seeing HMRC raise questions, this is around the issue of donations and grants. Now, the typical starting point here is that no VAT's due because most organisations will treat this as a non-business activity. But given the change in the way donations are being structured, what we're providing to sponsors, etc., HMRC really do believe that there is potentially VAT due on the whole or part of that supply. And I think that's something that all charities should be reviewing in some detail. I think it's also worth being aware that when you're carrying out these reviews, that to take care with strategic decisions. So we've seen case law where a not-for-profit organisation may have decided to treat their income as business, and in the event that it becomes exempt business, it's had the potential unintended effect of removing reliefs that they would have otherwise have been entitled to. In one case, that could have been significant because of the reliefs available on properties. Now, I think if we move on in the interest of time, what is clear, Hannah, could we have the next slide, please? Thank you. I think what is clear, given the changes that we've all gone through and the operating structures that we've been adopting, now's the time to step back and gain a clear understanding of where you are today and where you're going forward, because that will require an update to your VAT treatment, your VAT processes, what you're reporting for and at what rate. This could give you opportunities to improve your VAT recovery, and in some circumstances, I would say, and probably in most circumstances, give you certainty on the way forward, both in terms of your charges and your income. Just very quickly, in terms of what's coming up in the next few weeks, the end of March sees the removal of temporary rates. Now, that's not as straightforward as we typically would expect, because we come across issues with correcting systems. Outside systems, there's also the issue of updating websites, invoices, contracts. So give your teams plenty of time to accommodate the return to 20% VAT. Looking forward, as of the 1st of April, we see a number of changes coming in. I think the first one would be for those of you that are not VAT registered but not currently operating, making tax digital. This becomes compulsory for those VAT registered businesses, even if that is under 85,000. I think critically, preparing for year end, given the changes that we've talked about, there are likely to be adjustments that you wouldn't ordinarily make. So I would say start planning for that. For those of you, as I said, interested in further detail, we will be running a tax-specific session next week. But I hope this has given you a flavour of some of the common issues that you could be looking at in the next few weeks. Thanks. So if we move forward. Caroline?
Thank you, Peril. Hello, everybody. My name is Caroline Harwood, and I'm a partner at BDO, and I head the National Employment Taxes practice. So what I thought we'd talk about today is the fact that during the pandemic, the biggest factor that has been facing many employers has been in what they do about their employees, be that whether they're on furlough, and Matt Harrison is going to talk to you about that in a bit more detail later, or whether you're looking at individuals who are working from home or managing with PPE and other methods of reducing infection during the course of the pandemic. Now, we're moving out of that now, and I thought it'd be helpful to set a little bit of context of where we are in terms of the future of work, what's been happening and where do we go next. So the unemployment rate is currently 4.1 and falling, so much, much lower than was anticipated at this point in the cycle. Vacancies are up by 460,000. So there are fewer people available for more jobs, which is making a significant pressure in terms of how you get the right people on board to work within your organisation. And I'm going to look at that in a little bit more detail in a second. We've also seen an increase in the economically inactive. So that's up 400,000, an increase to 21.3% of the population are economically inactive. Now, that might be people who have retired in the normal course of things, or it could be people who have retired early because they've looked at whether they can financially afford to do so over the last 2 years and decided that they can. And that equally applies to people who might not be at retirement age or close to retirement age, but have decided that they're not now going to take part in the world of work anymore because they've rearranged their lives so they don't have to. In terms of payrolled employees, that's gone up by just over 400,000. And the self-employed figure's gone down by 700,000. So looking at those two in combination, there are a number of factors that could be in play here. So not only the increase in the economically inactive, but also issues such as the introduction of the rules known as IR35, or the action against what they've called disguised employees. So individuals who are to all effects and purposes an employee of your organisation, but actually they're working through a personal service company and they have been historically treated as self-employed. That has obviously been changed for over a year now, and we'll look at that again in a little bit more detail in a moment. So next slide, please, Hannah. So what we're actually seeing in the marketplace, the market for labour, is we are seeing pay increases. Now, you'll have seen the news concern that increased pay rises are going to push up inflation and push up the cost of living increases as people are paid more because they need to have more disposable income to meet the rising costs of goods and services. A lot of that is driven by the increase in energy prices, which has an ongoing effect into the prices of food, domestic goods, etc. So there are pay increases out there in the market which are looking to ease that pressure for employees, but the pressure is therefore on for employers, particularly those who don't have big budgets and are trying to meet their employment needs in a very, very difficult labour market. So what we need to be doing is focusing on retention and attraction of employees in the workplace. How can you make sure that you can get the right people into your organisation to do what you need them to do? And a lot of that is around making sure that you target your spend on what they want. So when did you last review your benefit package? Does it still meet people's needs in terms of their current working arrangements? So if you had on-site provision of various facilities, but now the majority of your people who were in an office are now working from home, is that a good use of your money, or can you do something different that is more effective for the employees? Contract rates are increasing, so that's for your self-employed workers. So how is that best managed? Can you negotiate contract risks? How do you budget for that? And one of the things that a lot of people are doing is revising how they deal with overhead. Agile working is more popular, and that's been driven to a great degree by workers themselves, but it can also generate substantial savings for employers, and that's been obvious through the pandemic as costs of office buildings, etc., have gone down. So look very carefully. Does it work for you? Does it work for your staff? And if it does, how does that impact your cost base? Are you keeping the lights on for an office which is 2/3 empty? Should you be? So have a look at that. And finally, one of the important things that we really do need to be considering now are the increases in national insurance. Now, what we're talking about here is the health and social care levy. Now, it's just a 1.25% increase, isn't it? Well, no, it's not. So there's a 1.25% increase in national insurance for employees, for employers, for the self-employed, and importantly, there will be an increase for employees or self-employed people who are above the normal retirement age. Now, that doesn't work in the same way as the increase. So initially, from the 6th of April, next month, so April 22, the health and social care levy is being introduced by way of an increase in national insurance. So all you will see is a 2.5% increase in employment costs for your average employer, 1.25 for you, 1.25 for the employee, just across the board. That changes on the 6th of April 2023 to the health and social care levy. Now, in many cases, that will mirror the national insurance treatment for your employees, apart from the self-employed, those above normal retirement age who will have the health and social care levy, whereas they wouldn't have been paying employees' national insurance. So you need to make sure that your payroll systems will cope with that. You've got a year's worth of run up to get there. The other things you need to think about is where you have rights to deduct national insurance from payments to your employees. You need to make sure that from the 6th of April 2023, any relevant agreements also include the health and social care levy. It is separate and you will need to deal with it as such. So if you need to go back and review documentation, make sure you do that through the next 13 months. Next slide, please, Hannah. So I mentioned IR35 and labour market issues earlier. What can you do to deal with labour supply chain risks? And I think it's important to remember that we've had really a soft touch in terms of IR35 and how employers treat their off-payroll workers, but that stops next month. So we can see far more pressure coming in from HMRC from next April. They'll be looking at the schemes that have been increasing in popularity, which are typically things like mini umbrella companies, which are designed to save national insurance. The use of things like statements of work. Now, statements of work are very useful because if somebody works for you under a properly drafted and accurate statement of work, then you don't treat them as off-payroll labour. You don't need to apply rules such as IR35. They're somebody providing you with a service. So it might be the person that comes in and cleans your windows once a fortnight, and they have 200 other clients. They are clearly not someone who ought to be treated as one of your employees. But we're seeing an increase in the drafting of statements of work that are purporting to take you out of the rules, but actually the reality of the arrangement is nothing like the statement of work that's drafted and should be very carefully treated within the off-payroll worker rules. Status determination should be done in relation to those workers, and status determination statements should be issued to the relevant parties in the chain. Now, all of this is putting a lot of pressure on the self-employed models, and HMRC is introducing a new task force which is funded to the tune of £100 million. They'll have over 1,000 officers checking that businesses are operating their status checks correctly and then going forth and taxing people correctly as well. So do be careful, make sure that you are doing your due diligence on your labour chains very carefully. If you're not comfortable with how IR35 might apply to you as an employer, then it's very important now, before the soft touch goes, that you take a little bit of time to review your processes and policies. Make sure that they're in line with the legislations. Make sure that your contracts accurately reflect the arrangements with your workers. And if they don't, take action now to make sure that you are completely compliant with the new rules that have been in place now for a year. For some where they're public bodies. Next slide, please, Hannah. So as I was saying, we need to make sure policies and procedures are in place. Not only now, but you also need to perform periodic reviews. So if you have longer term contracts with people you're treating as self-employed, check them every 6 months or so, just to make sure that your contracts are still accurate, the status determinations are still accurate. And has something changed that might cause you to now treat somebody who was previously genuinely self-employed as an employee for tax purposes? It's important to remember that this is a tax issue, not an employment law issue. You should look at that separately. And if your worker is employed by their personal service company or by an agency, then they deal with the employment law, not you. But look at it very carefully and make sure you're comfortable. Make sure you understand which of the bodies in the list there are included in your labour supply chain. Next slide, please, Hannah. So in terms of your employment tax considerations, what do you need to do about agile working? So about 2/3 of employees are now going to be moving on to a hybrid working model, according to latest estimates. It could be different, that could be more, could be slightly less, and I'm sure things will evolve over the next year to 5 years. But there are a number of things that you need to be clear about from employment tax's perspective. And the first of those is, what is the individual's normal workplace? Because if their normal workplace is still an office, that they spend 2 or 3 days a week working from home, that does not mean that you can pay their commute costs into the office for them without it becoming a taxable benefit. You also need to be clear where they can claim for travel and subsistence costs and what the tax impact is. Is somebody going from home to a different place of work? So to, let's say it's a care worker, are they going to somebody that they're caring for? Is it somebody who's going out and presenting to an organisation or a school, for example? How do the expenses work? And make sure that this is all written down very carefully in your policies, and make sure that you perform checks so that you are ensuring that expenses and subsistence claims are for what they're supposedly for. You may have individuals who are travelling and working internationally. Where you know about that, where it's part of their normal day job, you will have tracking systems in place. If you haven't, make sure that you've checked them recently and they're still up to date. But you may find that you have individuals who are working remotely in more of an administrative role, and you don't know where they're working. So, for example, I had a client who was genuinely surprised to find out that one of their workers was working in Germany. What had happened is they'd gone back to work with their family. They were working from their family business premises in Germany, doing purportedly UK work for a UK employer. Now, you need to be really careful, because not only do you have potential withholding issues in the other jurisdiction in respect of that individual, but if they're making any form of management decisions, you could be making a permanent establishment for tax purposes outside of that jurisdiction. And if that is relevant to you as an organisation, you need to make sure that you're not doing it unless you actually want to be doing so. The other thing you need to think about if somebody's working from home is that we have a duty of care as employers to our employees to make sure that they're sitting in an appropriate chair and that they've got the right equipment to work from home, so that it isn't detrimental to their health. And what that has meant over the course of the pandemic is that office equipment has been supplied quite widely to home workplaces. And until April, there has been an exemption as to how that is taxed. So if the employee orders a chair, the chair arrives, costs a couple of £100, and you reimburse that for them, that has been tax-free. That will not be the case from April. That becomes a taxable benefit. And there is a difference, believe it or not, in the way that the provision of such equipment is taxed, depending on whether the employee pays for it and you meet their liability, or whether you pay for it and just lend it to the employee. The latter is an awful lot more tax efficient in a lot of cases, not always, but in a lot of cases it is. So review where you are on that, particularly if you're new to home working, and make sure that it is tax efficient as possible. And as I said earlier, monitor travel expenses, other expenses, and travel providers to ensure that they're being taxed appropriately. Hannah, next slide, please. So in March, I cannot do an employment tax webinar without mentioning deadlines, because we're coming up to them at the end of the tax year. So please don't forget, and I'm not going to read out this slide, it'll be in your pack, so please do refer to it, but you have deadlines coming up for P11Ds in July, for your PSAs in July and October, but make sure that if you're applying for a PSA, now what that is a PAYE settlement agreement where you want to pay the tax instead of an employee if you're providing them with incidental benefits that aren't within the genuine exemptions for tax purposes. So make sure that you've applied for your PSA in time, or you've changed it in time for this tax year. Make sure that if you are related in any sort of way to employment-related securities, and that will be unusual within this group, but sometimes it's not unheard of, particularly around loan instruments, make sure that any reporting is done. And finally, short-term business visitors. If you have international workers, make sure that you're looking at the appropriate deadlines for your filings. So finally, parting shot, don't forget to include changes for the health and social care levy on your pay slips going forward. And now I'm going to hand over to Matt.
Okay, we're just going to have a little bit of a look through CJRS, the Coronavirus Job Retention Scheme, or furlough scheme, as it's become known. So we're just going to have a look at three main areas. So where are we now, how it affects charities, and things that you can do now. So if we go to the next slide. As you will all be aware, the last opportunity to claim was for the September 21 period, and that claim needed to be in by the October 21. So the scheme, as we know it, is closed. But with the advent of the scheme closing, we saw a subsequent increase in HMRC activity around around reviewing the CJRS scheme. So it was almost like as one door shuts, another opened. So we're not necessarily looking at how we claim now, but looking at how we can check and review the claims that have already been made. HMRC have already come out and stated that they expect a loss of between 3 and 7 billion pounds worth on the furlough scheme. Now that could be a mixture of fraud or error or what have you. So unfortunately, the way the legislation is written, HMRC aren't just looking at kind of the more obvious cases of fraud, which is slightly outside the topic for today, but they are looking at where errors have been made in claims. That works out to equivalent of about £608 per person claimed for. It's roughly about 10% of the total amount spent on it. It's about 70 billion spent on the furlough scheme, and a rough 10%. So when HMRC are doing the reviews, they're effectively expecting to see a 10% error rate in relation to claims made. And in terms of all the reviews that we've done so far, which we've done kind of heading up towards over 100 reviews in the last 18 months or so, we would say that's a fairly reasonable estimate. But they've also got a full 6 years to kind of go at this, so it's something that's going to be around for a little while, so it can't just be ignored. For those of you that have to fill in a corporation tax return, there is CT reporting requirements as well. So this is an additional part of the CT return, almost where effectively it's asking you to say how much you've claimed, how much you think you should have claimed, and giving you an opportunity to repay any overpayments. But this sits separately from the normal kind of accounts information. It's a whole separate part of the CT return. And because of that, then we've seen there some cases where it's been missed, I say because it's got added in at a later date. We know that HMRC are now cross-referencing claims to returns. So if a return has gone in, and they can't reconcile the figures in these new boxes, it's boxes 471 onwards, then they are starting to ask questions. They're also starting to issue nudge letters, asking businesses, asking entities to kind of to help reconcile the figures if they can't do that. In terms of their penalty position, we are finding that they are being a bit more light touch at the moment. Whether that attitude stays, the further down that 6 years road we go, time will tell. But we have seen that they seem to be more interested in recouping the overclaim rather than charging a lot of penalties. The only exception to that, which we've only just recently kind of become aware of, is where there have been substantial claims made and there's been no professional advice taken. So that's where either during the claims were made, no proper advice was taken, or even now where claims haven't been reviewed. Sorry, just lost my track there. Haven't been reviewed by a third party as well. So they're very much seeing it as, if it's substantial, then there's a duty of care to actually have that looked at. So if we just want to flick over onto the next slide. How has it affected charities specifically? There was a recent Charity Commission survey, and I imagine none of these figures will surprise you, that obviously COVID affected 72% of charities' financial position. It affected 66% of their staffing, and although there's a high volume of kind of volunteers within the charity sector, there's obviously a high volume of staff as well, and at least about a fifth of staff across the board were furloughed. In terms of the CJRS income itself, it may not be taxable in itself as with a regular business, but that does depend on who you furloughed and what activity they were undertaking for charities. And something that is common across the board is that charities are still employers. So I know there's a myth goes around that charities don't pay tax, but those of you who have employees will know that that's not the case. So the same obligations arise for charities as they do for regular businesses. So, and one of the messages that we're getting quite clearly from HMRC is they expect claims to be reviewed in light of current guidance. Now, we've seen those of you who've been involved in claiming furlough will appreciate that the guidance and the information at the very beginning was had a lot to be desired, but HMRC have come out now and said they want it reviewed in light of the guidance as it sits now. So there have been various things that have changed and approaches changed over the last 2 years in the guidance. So they're effectively saying that they expect a review to be taking place, preferably a third-party review as well. In terms of the work that we've been doing on this, some of the main issues, there's 101 different issues with CJRS and many places where it could go wrong. But what I've noted there on the slide is just some of the main ones that we've noticed when working with our clients in the charity sector, is the interaction with other government grants. Part of one of the conditions of the furlough scheme was you couldn't claim for furlough costs where they are covered by other grants. And if there's any form of salary sacrifice operated, whether normally that would be on the pensions or maybe childcare vouchers or such like. To do with the worker profile, in essence, the CJRS scheme was designed to work best for monthly paid salary people. So if you may have had people like working in shops who are variably paid, maybe people on 0 hours contracts, then their worker profile doesn't fit very nicely within the scheme, and we've seen where innocent errors have been made. I'm just trying to get your head around the rules for variably paid people and non-monthly paid people. And sometimes we've seen a reliance on third parties, maybe an over-reliance, because we appreciate that at the time that there may have been people short of resource, so payroll providers or other people were involved. And it's just to say that HMRC still see the responsibility lying with yourselves, so that they won't see it as an excuse of, oh, so and so did it for me. It's still up to the organisation to be happy that the work that the third parties was done is ticks all the boxes and would stand up to HMRC scrutiny. So if you want to flick on to the next slide. So I'm not going to go through this in a lot of detail. I just want to kind of pull out a few points. First one there is review historical claims. It's like I've said on a number of occasions already, HMRC do expect claims to be reviewed in light of the guidance as it is now on that. If there's substantial amounts being claimed, then we would advise a third-party review to be taken place. And what that does is it helps provide evidence that to HMRC that you have taken reasonable care, and it may indeed facilitate a voluntary unprompted disclosure, which is far cheaper and far less pain, and can minimise any kind of penalty positions drastically by taking that route. In terms of what you don't do is just don't bury your head in the sand effectively. HMRC and the government are throwing an awful lot of money at the reviews, especially over the next kind of couple of years. And so they are getting data from all their various sources. So if you're in any doubt, if you want to kind of have a bit more of peace of mind, then it's time to act. Like I said there, just hoping isn't a good enough defense on that. There's plenty more I could say on this, but I'm conscious we kind of need to move on. So I'll hand over to the next presenter.
Thank you, Matt. Hello, everybody. As Jill introduced at the start, my name is Jo Goswell, and I work in our Business Services Advisory team at BDO, focusing on global compliance services to our clients. In a world that's growing ever complex, my team help global organisations meet their local compliance obligations wherever in the world they're located. I've been at BDO for 8 years, and prior to this, I spent 13 years working for a global education charity. So I have some first-hand experience of the operational, finance, compliance challenges that the not-for-profit sector face overseas. Your organisation may already be working internationally or have aspirations to. In this section, drawing on the knowledge from our local BDO experts across our network of 167 countries, I would like to give you a global perspective to some of the themes you've already seen today, plus a little bit of a deeper dive into compliance in a couple of countries, just to give some examples that may be relevant for you to consider in the future. So why is the global perspective so important to consider? Well, regulation and compliance is becoming ever more complex around the globe. Digitisation of reporting to government authorities, the increase in geographical mobility of staff accelerated by COVID, data protection legislation and changes to the regulatory frameworks are key challenges to global organisations. When this increase in complexity is also coupled with language barriers, time zone differences, and a general lack of visibility or understanding of compliance, the risks become compounded. In my presentation to you, I will unpack some of these to give a flavour of these challenges from around the globe. So if we accept that where there is complexity, there is risk, let's consider the degrees of complexity around the globe. This heat map uses data from the World Bank Group to show the comparative ease of doing business by country. The lighter the colour, the lesser the complexity, and the darker the colour, the greater the level of complexity. So visually, we can see that generally the places where it's harder to do business are in those countries that have developing economies or where there has been political instability. The countries that are ranked as the least complex are highlighted in yellow. And in order of lesser complexity, New Zealand, Singapore, Hong Kong, Denmark, and South Korea are the least complex places to do business in the world. The most complex, in the dark blue, are concentrated in Central and Northern Africa, Somalia, Eritrea, Yemen, and Libya ranking as the hardest places to do business, plus Venezuela in South America and Haiti in the Caribbean. One of the key factors that the World Bank consider for their rankings of complexity are the accounting and tax systems in country. Argentina, Bolivia, Greece, Brazil and Turkey are 5 of the countries with the most complex accounting and tax compliance requirements. And in terms of accounting requirements, IFRS adoption is greatest in North and South America, while local GAAP is in place in 71% of APAC and 44% of EMEA countries. And to give some perspective to these rankings, the UK ranks 27 in terms of tax administration complexity. So digitisation is an important feature of complexity as more governments seek to transform their tax systems. If we consider the impact of making tax digital in the UK, it was intended to make tax administration more efficient, effective and simpler, but has been criticised for having the opposite effect. And this is becoming a growing trend. Bookkeeping requirements are becoming more specific. A growing number of countries are moving towards digital transaction reporting requirements, giving governmental authorities regular direct access to your transactional data. If we look at the current position by global region, the position is quite mixed. In South America, it is reported that 70% of jurisdictions have made electronic transaction reporting mandatory. This compares to 34% in Europe, Middle East and Africa, and 15% in Asia Pacific. But the expectation is that the e-filing and e-reporting requirements will continue to grow. The likes of Vietnam, Japan, and the Philippines and Germany are all introducing new digitisation schemes in 2022 and 2023. And the business and economic impacts of COVID-19 are expected to accelerate this growth in digitisation. And of course, as Caroline noted in her presentation in respect of social mobility, COVID-19 has impacted staff mobility with a growing move towards working anywhere, which for your team might mean working overseas. Whilst the opportunity to work this way may offer greater flexibility and mobility in your workforce, the business obligations that arise from this must not be overlooked. Where staff are working overseas, even for a short time, they may become entitled to local employment rights, which may be enhanced from those in the UK, for example, statutory holiday pay, minimum wage, or termination rights. Indeed, in some countries, such as Mexico, there are strict criteria that limit the circumstances under which an employee can be fired, and strict rules around the process. Because of this, it is customary in Mexico to negotiate a termination settlement with an employee rather than go down the termination route. Global regulatory framework requires employers to carefully manage the tax programme for their workforce. Not easy where local employment regulations are changing so fast. And there are some specific changes to the regulatory framework specific to accounting, hiring, and company secretarial requirements. On the plus side, many governments are taking a flexible approach to tax audits and accounts filings, acknowledging the strain that COVID has placed on organisations. Countries are moving away from more traditional requirements of local stamps, chops or seals to validate office documents, making local compliance easier to manage. Both Hong Kong and Argentina removed this requirement in 2020, for example. More countries are also moving away from paper-based filing to e-filing, reducing the admin burden on organisations. But on the downside, there is a growing trend towards requiring reporting in local language. More than 80% of countries now require this. Local GAAP accounting requirements have also created complexity or duplication where there are group settings, and increasing employment protections create additional compliance challenges and costs for employers. And whilst we're all hopefully familiar now with the requirements of data protection and GDPR, where we have operations around the globe, we need to be mindful of compliance with local data protection legislation and its interaction with our own. And we should not forget that GDPR applies to the personal data of UK and EU citizens wherever in the world they are working. And this is particularly relevant to the payrolls for expat staff, where personal data is required to be shared across territories in order to manage the payroll processing and reporting. And more countries are bringing in their own legislation. Brazil, China, and Zimbabwe all introduced new data protection laws in the last 6 months. So I thought it might be useful to provide specific on-the-ground country updates, and I selected somewhat randomly a couple of countries for this. With the help of my local BDO experts in Thailand and Peru, in the next 2 slides, I can share an overview of compliance in country. So starting with Thailand, starting operations as an NGO is not a straightforward process. NGO licenses are limited and accessing them is complex. A practical solution that some NGOs are choosing instead is to partner with local universities and utilise their not-for-profit status. Commercial activities undertaken by NGOs also need careful handling in order to manage local compliance. Similar to recent issues with NGO licenses not being renewed in India, as widely reported in the press, and impacting significant well-known international charity organisations, Thai authorities are also taking a much closer interest in reviewing renewal applications for licenses, with reports that the licence for Amnesty International has recently lapsed while still being under consideration by the Thai authorities. In respect of working visas, expats are required to have a working visa, and these are issued on a 1-to-4 ratio, with local Thai employees being required on a ratio of 4-to-1. However, the local cabinet in Thailand are proposing to reduce this to a 1-to-1 ratio, making it easier to do business overseas. And expats are tax resident after 180 days in country. So going back to the staff mobility point, it's important to understand what those obligations are in country, because they will vary from country to country. In terms of accounting, Thailand is introducing digitisation of its tax system. And in terms of auditing, there are very few exemptions to audit available in Thailand, with most enterprises requiring a local audit. And so a quick look at Peru. So NGOs in Peru are monitored by the Peru Agency for National Cooperation, but being an NGO does not provide automatic tax exemption. Instead, this is applied for and considered on a case-by-case basis. Peru local GAAP requires local bookkeeping to be maintained in local language. And Peru has enhanced employment rights that include bonus pay months, statutory overtime premiums, life insurance and holiday pay. COVID grants and loans were available to businesses, and the Peruvian authorities are now validating that these funds were correctly applied, not dissimilar to what HMRC are currently doing in the UK. So I hope this very brief run through has given you a little bit of high-level oversight to some of the compliance challenges that need to be considered when you're operating overseas. In terms of BDO's global capabilities, in my role, I'm supported by a vast team of local experts across the 167 countries where BDO has offices. The breadth of the BDO network is greater than that of our competitors. Wherever you are or aspire to be in the world, we want to be there to support you. And indeed, even in the countries where we do not have a BDO office, we do have alliances with local firms so that we can support our clients. Our delivery model provides a centrally coordinated, locally delivered solution, giving you access to our professional experts on the ground, helping you manage your compliance risk and freeing you to deliver your organisational goals. More broadly, our services include global compliance and reporting, global payroll, global financial reporting, global tax advisory and global employer services. In my slide, I've included a link to the BDO Global website, our dedicated global site that provides information and publications from around our global offices. But ultimately, we're a people business, and as such, we always value our client conversations. Please do feel free to get in touch if you think we could be of any help with your global challenges, and we can start that conversation with you and with our global network of experts. So that ends my presentation. I'd now like to hand over to Jason, I'm hoping, from South Africa for an update on cybersecurity.
Thanks, Joanne. And yeah, I am in South Africa on holiday, but I would never miss an opportunity to present to you all and quite a topical conversation. As always, a bit of a cyber update and with unfortunate events unfolding in Ukraine, some additional guidance that I've included in which adds some additional context for the presentation. If I could get the next slide. So typically the presentation, and those of you that would have heard me speak before, I've spoken about threat actors, and today we're really going to focus on two main threat actors, which is the organized crime, syndicate type activities, and then state-sponsored attacks. And really two headlines that I've put on the screen, which is Ukraine crisis wiper discovered in the latest cyber attacks. And what we're seeing at the moment is typically malware that's being deployed, specifically in Ukraine, was detected to be deployed and with the sole purpose of actually destroying data, which is typical of a state-sponsored type attack where there's no real value seen in terms of trying to extort money, which would be the modus operandi of an organized crime unit, but rather just to get in and destroy the data and actually render the target organization unable to operate. So that's one topic that I pulled from the headlines, and the other one is the National Cybersecurity Center, which is advising organizations to act following Russia's attack on Ukraine. And we're seeing this across our entire client base. First of all, heightened awareness of the risk around cyber, but also questions asking what can one do, what should one do, and on the next slide I have some points which I'll walk you through. So this is the guideline verbatim from the NCSC website, and I encourage all of you to go and download it. It's a simple checklist, so very quickly make sure that your patches on your systems are well patched, verify that the access controls that you have in place are adequate. So make sure you've got things like multi-factor authentication. Those are the types of controls that we would expect to see most organizations have from a posture perspective. Ensure that your defenses are working. So what do they mean by that? That you've got the latest antivirus patches, you've got logging and monitoring, which kind of moves into the next point. You've got adequate backups. So in the case of getting a cyber attack and specifically either with a wiper type malware or with an extortion type malware, which would encrypt your data and then ask you to pay Bitcoins, backups become quite critical. And the one that's probably the most important component for me out of all of this is the incident response plan. So very quickly, a few questions that you can ask yourself. One, are you aware of an incident response plan within your organization that caters specifically for a cyber attack? When last was it reviewed? When last was it tested? So either a tabletop exercise or something a bit more comprehensive than that. So incident response plan is a core one for me. Check your internet footprint. So basically, it's a case of where you've got services running. Are they secure? Are they well tested? Phishing response. So for me, over there on the phishing response, that's quite an important component. Make sure that the organization is aware of the threat around phishing type attacks. Have you done security awareness training, those types of stories? Do you have major third-party type providers that you're engaging with? And from a third-party access perspective, the access that they have into your organization, is it well monitored, and have you reviewed the access that they have? And then NCSC offers some sort of service where you can enroll your organization, you can get access to the latest information and methodologies, and that's quite an important component. And then briefing the wider organization if you feel it necessary, just based on the overall threat profile of the organization. So this NCSC guidance is straight off their website, and please, I encourage you to all go and download it. And with moving on to the next slide, I'm going to really be talking a bit about incident response plans and some of the data that we're seeing. So sticking with the NCSC, in 2021, I'm not sure how many of you are aware, but they did a cybersecurity charity survey, which was quite interesting. And what I've done is I've extracted some of the content and slides from this. And apologies, it is a condensed presentation because I only have 10 minutes, but there's some key messages here. So I think that the major one is that about 50% feel that they are likely or very likely to be a target of a cyber attack. And then the other 50% kind of posturing between neither likely to I don't know. And I think the short answer is that in reality, you will all be the target of some sort of cyber attack, and one either it's going to be very targeted, or what we like to call is a spray and pray, where an attacker may target you indirectly, not knowing it's specifically you, but just send out random phishing emails, attack a third party that might have access to your core systems. So the reality is and not to create fear, uncertainty, and doubt, but there's a high probability at some point you're going to be the target or victim of some sort of cyber attack, and that's what the data is showing us within the community. It's a likely event. So I think what we'd like to do is to see more awareness across organizations for acceptance that this is going to be a reality at some point, being the target of a cyber attack. If we could move on to the next slide. So the question here is, does your organization have a plan in place in the event of a cyber breach? And this is talking directly to an incident response plan. So the encouraging thing was that 61% of the sector have a plan in place should there be some sort of cyber event, which is very, very promising. But the more concerning thing is if you dive into the detail of what that slide is actually telling you, is that across larger charities, they are more likely to have an incident response plan in place, which means that the smaller charities within the sector are more likely not to have an incident response plan, in which case more likely that should they get attacked, there'll be some sort of greater impact to them because they're less prepared. So I think that's the takeaway from this slide. So please, I ask, just go back and kick the tires around that and see whether you do in fact have some sort of incident response plan in place. As we move to the next slide, if we look at the plans by organization size, what it's basically asking the respondees is, does your organization have a plan in place in the event of a cyber breach? And it's done by organization size. So, this is just kind of talking to across the sector, the different size of the charities and whether or not they have a incident response plan in place. So just kind of reinforcing what I'd said. So you can kind of see as you get to the larger charities or the super major charities, the answer to the yes becomes significantly greater than the no, which is encouraging. One might argue that they are better prepared and potentially better funded, but that doesn't necessarily make them more or less prone to a cyber attack. From a targeted perspective, yes, but from indirect, one can argue they're likely to be targeted. Will an attacker be more successful? Probably not, because they would have a stronger control environment. If I could get the next slide. So this is around behavior analysis. So has your organization's attitude or behavior changed recently? So the context behind this is going through the pandemic and obviously just leading up to a heightened awareness around cybersecurity. And basically this is the changes that we're seeing across the sector. And basically, on the top 3 bars, we're saying close to 50% have recently installed cybersecurity software or software that is specialized around cybersecurity attacks, done more security awareness training, and attended more events. And I think the one that's concerning is the bottom one, well, the second from the bottom, apologies, is the cybersecurity is talked about more in the board meetings. I think we're only seeing a 22% change. Now that could be read in one of 2 ways. One being that it's already a well talked about topic within the board, but I would say that's we probably need more change and more board awareness and better appreciation for the requirement of funding and commitment to the organization from a cybersecurity perspective. So we'd like to kind of see, we'd like all of these things to be higher, but I think the discussions in the boardroom are probably ones where we'd like to see more of a positive change. And the change isn't necessarily about getting the experts in to talk to the board, but actually the board talking to the people within the organization, the IT director, information security officer, about cybersecurity. So just moving on to the next slide, and just mindful of time. So this is just kind of very quickly, I'm going to spend 5 seconds here. Social engineering is the major cause of breach across breached organizations surveyed, and this is out of the Verizon Data Breach Report, which is a free report, and a lot like the NCSE guidance is available online. Please download it. And then, kind of correlating with that in terms of where the threat actors come from, you're seeing organized crime as the major threat actor involved in using social engineering to gain access. You will, in the next, if we look at the data next year, looking backwards, we will see that change. And we will see more of a nation state type of activity, and they're more likely to be attacking using specialized zero-day, which is vulnerabilities that haven't necessarily been identified within the industry. They'll be using those for their types of attacks, and less likely social engineering. If we can just move on to the next slide. So this wraps up my presentation, and apologies, I'm running 2 minutes over, but in a summary here, there are 2 things that I'd like to leave you with. The NCC guidance is excellent. I think it's a good starting point. It focuses in on the most important questions you should be asking the organization, especially now, just given the heightened awareness with what's going on with Ukraine and so on and so forth. And there's a general feeling that as things progress, cyber attacks will become more prevalent. So I think that's one component, and it may not necessarily be a nation state. It could also be the component of using the messaging of what's going on in Ukraine to attract people to click on links that they maybe shouldn't click on. So very similar to what we saw when COVID first, the pandemic first took place. It was, click here for the latest COVID updates and so on and so forth. So those types of avenues of discussions will be used by threat actors to target organizations, and they're likely not to be nation states, but rather the organized crime units. So that's the number one, is the NCC guidance, and the second thing is the incident response, which I really, really recommend going back and kicking the tires around. I'm going to pause there and thank you all for hanging on. Joel, over to you in the studio. Thank you very much.
Thank you so much, Jason, and very pleased that the technology worked for us there. We have had a few questions come through, which we've been answering as we've been going through. I'm sure you've been seeing that in the Q&A, but we do still have one open question, which is for Jason. So Jason, if I could just ask you to pop your video back on. The question is, what's your opinion, please, on I'm going to pronounce this incorrectly.
Kaspersky.
Would it be prudent to move away from utilising them for antivirus solutions, or would this be overly cautious?
So I'm going to try and answer it without creating fear, uncertainty, and doubt. So this is quite a topical conversation. So for those of you that don't know, Kaspersky is a antivirus organization that's based in Russia, if I'm not mistaken. That's where the origins come from. There's been a lot of talk around this. I'm not aware of any analysis that's been done that might indicate that that it's there's some sort of covert operation that's being funded through Kaspersky, and you should move away from it. I think the short answer is that if it's coming up for renewal and there are options on alternatives, then potentially it may be the safer option. I think the bigger concern is as the sanctions come in, you could be in a position where you won't be able to purchase the software because of the sanctions. Mm-hmm. And I think that's where the greater risk is that you may not be able to get the support, you may not be able to get the updates. And just based on that, moving away from the other risks associated with the software, I think there it would be prudent to move away from it. Would I do it tomorrow? It's also footprint dependent. If you've got five workstations or 10 workstations, it's quite an easy and quick thing to do. If you've got 5,000, that's a bit more of a measured approach. But I think err on the side of caution. I think if the sanctions carry on and then you're unable to get the support or the patent file updates, then I would certainly move away. I think on balance, if somebody was asking me the question, I would take the footprint, the efforts to change it, and if it's a fairly low risk and easy thing to do, I would do it just because I think it's prudent, just given the support component. I hope that answers the question, and and I hope I've done it justice.
Super, thank you, Jason, really helpful. So really just to wrap up, we've had a lot of information that we've shared with you today. Liz took us through the accounting and audit update, lots of helpful tips from the FRC, which are worth dipping into, those thematic reviews on going concern and environmental reporting, and also the complexity of auditing defined benefit pension schemes, which I know there's been a few questions that we've been answering as we've been going through. Parallel's VAT section, really just looking through just the change in use of buildings and how we've changed our services impact on partial exemption recovery. Don't miss the time to apply for that. Caroline's employment tax, lots going on, of course, in the labour market. National insurance contributions are, of course, going to increase our payroll costs. So we've got quite a bit to do over the next 13 months to get ahead of the game for that, and IR35 as well as those agile working considerations. Matt took us through furlough. Complex area continues to be so, and HMR challenge is coming. So some helpful do's and don'ts there. And a great session from Joe on global working for those INGOs on the sector and those that are looking to move and expand overseas. And then obviously finishing with Jason, taking us through those increased threats because of the situation in the Ukraine. We're very grateful for him giving up time on his holiday. We have been seeing it, unfortunately, a number of cyber attacks across the sector. I've had a few clients that have been impacted, both from a financial gain incentive, but also just to really disrupt the operations of charities. So something a little bit different than what we've seen previously. So I hope all of that's been really helpful. Our next seminar, as we've mentioned, is actually next week. That's building on a lot of the tax content that we've touched on today in a bit more detail. That's on the 9th of March, again, starting at 9 o'clock. Apologies, Colin, get your coffee ready if you're on that one as well. So we're really grateful to all of you for attending today. Please do fill in our feedback forms that we'll send around with the slides and the recording. It's really valuable for us to understand your feedback and to continue to improve our content as we move forward through the webinar series. Thank you for your engagement and your questions. A huge thank you to Hannah for organising us for today, and a massive thank you to all of our speakers who have given up their time to update us and all of that. So have a lovely rest of the day, and thanks again. Take care.